Well, they're kind of old-fashioned now and sell you on the idea of active management. There's a portfolio manager there. He's buying and selling. He's using all these,
Those words, synergy.
economic.
Actually,
Why shouldn't I sell all my holdings and wait for a dip?
because you can't predict it.
Okay, well, one of the things that's going on is the Federal Reserve is continuing to dump enormous amounts of money into the economy. Everybody just got their $14 checks. And all that cash is going to, they think, is going to continue to make this market more gasoline on the fire. So your theory is correct, but the timing is probably wrong until closer to the end of this year. There's a problem with value stocks, which is called a value trap. So people, this stock, because it looks so cheap, because the PE ratio is like 5 or 6 or 7. But then if you look at the history of the chart of the stock, you find out that it never makes money.
What's
PE?
Price to earnings ratio. So basically what the price of the stock is versus the earnings. I've got this little field here, this target price. This is kind of like the best valuation at the time for it, like based on 30 to 40 industry experts. They say, hey, we've done a lot of valuation, and so this is probably the price point that you want to look into getting at.
Every January 1st, you put into a portfolio the very worst performing stocks in the Dow. And then 12 months later, you're going to sell those and you're going to buy that year's worst performing Dow stocks. And so if you chart that against the S&P 500 or against the Dow Industrial Average, it's a very interesting chart because most of the time the dogs beat those indices.
Sell the losers under a year because I can use that loss as a short-term gain. And so I can basically say, hey, as my actual income, I actually lost money from investing in these companies.
Let's just say that I make $10,000 a year day trading, right? I'm going to hit a bigger tax rate doing those day trades than I would holding those stocks for over a year.
Yes, significantly higher. The only way to make money is to find really high quality companies that make a lot of money that are being sold at ridiculous prices. You can buy them at very, very low valuation prices.
Only a mutual fund can tax you on embedded gains. An ETF never does that because an ETF is structured like an individual stock. So if you buy an ETF at $100, and it goes to 110 by the end of the year, you don't get any taxes on that. It's only if you sell it.
What is your estimated yearly return using this strategy?
Reading not only the book, but also just kind of researching it a little bit more on multiple websites and obviously YouTube and things like that. The kind of average return higher than the S&P is 15 to 20%. The highest it got is 30% year over year, which is amazing.
What's like worst case scenario?
A worst case, there were a few years where it did underperform from the S&P 500, but it was 1 or 2%. And so it's just like, do I just want to throw my money in the S&P 500 and kind of get obviously market returns, which S&P has been earning 10 to 15% year over year, which is pretty decent, but I want more money quicker. I'm always looking for a PE ratio between 5 and 15. Because that's usually a really good value there.
How do you come across the companies that you want to enter into your spreadsheet there?
So that's the website. The book itself actually built out a website saying, "Hey, here's our screener. We look through the entire S&P 500 and then some, and we look at the ROA and we look at the PE ratio. Those two ratios are the main things that we look at."
Okay, so what it is, it mathematically puts in your concept of choosing momentum as one of your components for decision making. So it's the price earnings ratio divided by the rate of growth.
Okay.
Called PEG, P-E-G. And you should just look it up, Google PEG, because it might be a useful tool for keeping you safe from buying what's called a value trap.
What's the difference between value stocks and growth stocks?
stocks have a low PE, price to earnings ratio, they tend to be less volatile than the growth stocks, which have high price to earnings ratio. All of your trading, if you put $10,000 in 10 different things, and one more position, put $10,000 into MDY, and then you got a horse race, and you just see if anybody can beat MDY, because it has no research and no human interference.
The whole idea is just to see companies on the rise, buy them, hold them for a year, and sell them off. And so if you just continually do this, you're ultimately going to find these small diamonds in the rough, get them during one of their largest growth periods, and then sell them off.
A way to retire a little early is sometimes you have to gamble and put a lot of money in 1, 2, or 3 positions.
That's what Chris and I are doing with AMC and GameStop.
Mm-hmm.
We're gambling.
Yeah.
2 positions.
I mean, in doing some more research on it, I found that there are other metrics to throw in there as well to really increase your returns. One of them was momentum, which is basically, hey, have they been growing consistently over the last 12 months or 6 months or something like that? And it seemed that 6-month momentum was one of the best quantitative metrics to use in conjunction with this.